Well, welcome everyone to another recording for 25 Financial. This one's a little bit different. We're going to talk about traditional investments only, really not an alternative investment fund that we're presenting. Instead, we have two of our partners. We have Nathan Brooks and Brad Meyers. They are also part of our investment policy committee that works with Vanguard to sort of craft our portfolios, but also quell emotional pain that we may or may not be feeling. And that's kind of what we're feeling from some clients. A lot of you have sort of been trained into that mindset of buy and hold, and some of the things we'll talk about today with Nathan and Brad. But some of you, for good reason, have very legitimate questions that we would like to spend a little bit of time answering. So now, before we said that we were going to start recording, I think, Nathan, you were saying that everybody should just sort of sell everything and start picking stocks individually. Is that what were you saying earlier? What are some takeaways from?
Yeah. Secretly, this is the time to panic, but definitely. I actually saw a meme on Twitter about that it was like a headline: advisor tells clients this is the time to panic and get out, which obviously we never do. But yeah.
So right. So it's sort of funny to joke about, because it's sort of this feeling that we have. I have it with my money. I don't love seeing a swing of 10% in one day. I don't like that. Help us. Every couple years, we hit these swings, whether it be COVID in spring of 2020, whether it be 2022, where we had this direct correlation of stocks and bonds taking a nosedive. Help us get back on track emotionally and mentally. How should we view what's happening right now? Is the sky actually falling this time? And what are some fundamentals that we can look at high level, and then maybe specifically, what are some action items, if any, that we should be taking right now in the traditional markets?
Sure. So I think this whole talk will kind of boil down to just a couple very basic points that sometimes the challenge with investing is that you hear the same thing over and over, but you don't necessarily internalize it. And so the two big things that we'll be hitting in kind of lots of different ways will be markets work. And so you don't need to outguess them in order to have a good experience. And then secondly, diversification is your buddy. Spreading, don't put all your eggs in one basket. That's kind of the old adage there. Both of those things you can go very, very deep with. Those are simple ideas. Most good ideas are simple. And so you can go very deep with those two things. I'd add a third one, which is costs matter, and taxes are a cost. We're not really going to talk so much about the cost side of things. It'll be the first two. But just want to give an overall picture of where we're going, and then maybe some ideas about where we think markets are at right now, valuations, and maybe some action items you could take if you like. But basically, this will get down to, we're of the mind that you want to make a lot of the decisions about how much risk you're going to take beforehand. And therefore, when things like this happen, you can kind of invest and relax, as the phrase I like to use. So when we say markets work, there's one way of kind of, you can get that concept. It's another kind of level to make decisions out of that information. And then a third level would just be emotionally, when markets are doing this, you don't need to take the ride with it. And so it's really that emotional level that we want to help clients get to. You may have heard all the information we're going to talk about. But I can honestly say I haven't even had time to look at my portfolio, and I'm not worried about it. And I wouldn't be worried about it if I was 65, because we've made those decisions beforehand. So yeah.
I think that makes a lot of sense. I think we're going to have a certain clients, you guys are out there and say, look, actually, I kind of don't know that markets are working. And what do you mean by have a good experience long term? I would like a refresher on that part. And then others of you say, no, I think I kind of know, but I still need to hear it from you.
Yeah.
And so that's going to be the emotional piece. And so fire away. Love to hear
Sure.
and see some of the slides you guys have put together for the group today.
Yep. So I'm going to go ahead and share my screen. The first one is just kind of an anecdote here, but it'll illustrate that first concept that markets work. Another way, the academic way to say this is markets are efficient. The market is a price aggregating machine. And I'll explain this slide in just a second. But the way markets work is you have millions of buyers and sellers coming together every day to decide what stocks and bonds are worth. What am I willing to buy at? What am I willing to sell at? And that's what moves prices every day. It's like the most democratic process out there. That's why you see overnight large jumps when big news stories hit. So here's a way to illustrate that. An advisor, I think in 2013, he was having a conference for clients, put a big jar of jelly beans out in front and had all of his clients guess how many jelly beans were in the jar. Now, the guesses ranged from 409 all the way up to 5,365. That's the range that people guessed for how many were in the jar. The average of all of those guesses was 1,653. The actual number was 1,670. Okay, so this is how the market, this is obviously it's a metaphor, but it's how the market prices assets. None of us are really all that smart individually, but together you have so many eyes on all the same companies, literally millions a day, and it makes the price very efficient. It makes it very close to accurate. And so if I were to give someone the choice, and this could probably happen over and over with some variance, but give the choice, do you want to go with the average of how many people guessing how many jelly beans are in the jar, or do you want to take your own guess? Right? You really should take the average. Another metaphor I like to use quite a bit is the difference, if you're gambling, the difference between how the house makes out and just the average gambler walking in with a couple $100 hoping to get lucky. The market is a price aggregating machine, and it will work for you. That does not mean there aren't big volatile events that happen, but our ability to outguess what's happening is it's not good, and that gets proven over and over with data. So I don't know, Brad, do you have anything to add here?
No, when you showed me this first, it was a pretty big gap, honestly surprising, 400 to 5,300. And like you said, we're doing all the work on the front end to, ride out the volatility. And so I thought this was an interesting slide. I hadn't seen it before.
Nathan, and Brad, there was a quote that I heard by Warren Buffett, and maybe this is a good place to interject it and maybe tell me if not, but the best way to own common stocks is in an index fund that charges minimal fees. Sort of that sentence. And is that kind of what the metaphor is representing? The idea that, hey, you can try to guess whether Tesla, Nvidia, maybe one of what are described as the Magnificent Seven stocks that are driving the S&P 500, you can try to guess, or you can try to hold an aggregate of a combination of that. And maybe that leads into some of how we are choosing to do our investment management and how we sort of batten down the hatches, so to speak, with diversification before any of this actually even occurred.
Yeah. So given that this is true, and again, I'm showing a slide with jelly beans. I'm not going into a bunch of academic data, but it is there. It's called the efficient market hypothesis. People, a guy named Eugene Fama won a Nobel Prize over it. And so there's a lot behind this concept. So this kind of gets into what kind of a relationship do you want to have with your money? And if I can just give two choices, we can try to outguess how things are happening. And let me go to a different slide here. So here's kind of a ride since 1970 of the global market. And anytime you see a downturn here, that's like a major crisis. And so the one I have, I'll go to 2008 right here. Let's say you're at the beginning of this downturn and you're trying to guess tactically what to do at that point. Is that the kind of relationship you want to have with your money? The cost of being wrong, and we'll go into this, Brad has a few slides on this, But the cost of being wrong, basically you have to know the future, and none of us do. Or the other choice would be you can kind of, again, invest and relax. You can take the long-term markets working for you. When it's up, you feel great. When it's down, it's not like you have to feel good about it being down, but it doesn't need to bother you if you're a long-term investor. And I'll just say, even if you're 65, you are still a long-term investor. You will be an investor your entire life. The way you invest may change with how much risk you're taking, but you are still an investor for life because you're not taking all your money out at once. And so pretty much all of our clients are in this boat where we can let markets work for us over a long period of time. The way that a 70-30 portfolio acts over time is like the slide I was just showing you, except it's smoother. And so the addition of bonds smooths out the ride that you're going to have as an investor, and it makes things quite a bit smoother. Now, every year that you don't experience that on a year-to-year level. Every year it's up 10%, it's down 10%. It's kind of all over the place. But the accumulation of wealth over a long period of time, especially when you're adding in bonds, it's just, if you can put it in a picture, it's just kind of something you don't even want to argue with in terms of that approach versus trying to outguess what's happening.
And looking at this slide, it to sort of put a punctuation point on this, it's just a line, it's sort of a squiggly line as we look backwards, right? We have this hindsight bias, this hindsight benefit. But we lived through 2008, 2009, and the sky was falling. There were projections that this was the fundamental shift that we were, that's going to end everything. There were headlines that were sky is falling headlines. I don't want to gloss over that. The emotions tied to some of these downturns were significant in the moment.
Yeah. And it's one thing for sure. One thing to look at it on a chart. It's a totally different thing to live through.
Yeah. And so where we're at today, sort of putting this, I always like these long-term, these zoomed out charts for our clients to see. There were lots of significant events on this chart that brought significant emotional turmoil in the short term. What we are saying is, in the long term, even if you are 65 years old, even if you are 70 years old, you are a long-term investor. And so help us bridge some of the gap with what our clients should be thinking today, and maybe just some other points. You mentioned bonds also smoothed this out. And then some of the international diversification that you mentioned. Diversification is sort of our friend right now. What other points can we make on that front?
So yeah, just one quick point about diversification. What I'm showing is a map of the world. The size of each country is the size of the stock market in that country relative to the global market. And so in, plain terms here, we have the United States makes up 65% of the global market. Australia makes up 2%, Japan 5%, and so forth. Sometimes we get the question, China 3%, that seems very small. I thought they were a very large country. This is the public market. Most of China's market is private, and markets and economies are different things. So this is the public market in China that we have access to as investors, not their economy. So just a quick point there. This represents kind of our opportunity set, you might say, the areas that we can invest. And this is probably one of the unique things about our firm, is that we do not exhibit what is called home bias. We do not hold more in the United States than the 65%, or the market cap, in other words. So we will adjust the market cap as it grows. So if 65% becomes 70, we will adjust that. However, we don't overweight the US. We don't overweight any one country. And that comes out of that, again, markets work conviction, that efficient markets conviction, that markets do perform well at different times. So the U.S. is, if you've been paying attention, the U.S. has done very well the last several years relative to international. That does not mean that's a long-term expectation. And right now we're kind of feeling the reverse of that, where I think I haven't checked today, but I think the S&P is down, double digits for the year for sure. And what's kind of helping our portfolios though look quite a bit better than that. The two things that are helping that is that most of our clients have some in bonds, and so that those they're not as risky and they go down less. And then secondly, we're globally diversified, and international has not done as poorly this year so far. And so you'll never be the best, but you'll never be the worst if you globally diversify.
I think I saw a slide in here, year to date, at least first quarter, for international versus. Am I jumping ahead too fast here? Is there a way to navigate to that?
One of those.
Brad was going to cover it. I'll go.
Oh yeah, go for it, Brad. Put some punctuation, because man alive, it has been a 14-year bull run in the U.S. markets, and I have just had a bear of a time explaining to clients why they should continue in any international after the last 14 years. So can you help us understand and maybe use some of the historical, but then even this year, what we're seeing? Maybe we could take a little bit of a victory lap here.
Yeah, no, hopefully we've all been beating a dead horse for what's been the better part of a decade now. So we're happy to see this in at least, one quarter where international has outperformed the U.S. market. But you can see, it did 6% in a quarter, and the U.S. market's down about 4%. So that's about a 10% swing. And you can see bonds were up. I have a few other slides that are going to elucidate this point, but basically that's why we want to hold the market cap and everything. If you look at the U.S. stock market, there's about 3,000 stocks, and our portfolios hold around 14 to 15,000 individual stocks. And so you really do want to be globally diversified for times like this where you're holding everything. So I like this slide. I'm happy to be right for one quarter out of 40, but I think this is a good sign of things to come.
Well, isn't that funny? It's kind of even that language of, right and wrong. It's kind of interesting, right? Because it's like we even, sort of like, and I know you're using the language that we hear from clients, but the reality is it's an idea of diversification. And for 14 years, the U.S. market has done very well. Of course, the 10 years prior to the 14-year start was what has been described as the lost decade. I tell clients, if you put 100 grand into the S&P 500 in around the year 2000, and then around 2009 and 2009, you're looking at having 90, I don't know, a net of fees is probably $92,000. You'd have less money by far than what you started the decade with. And so, here we have a negative 4.72%. That's just the first quarter that did not capture the last 8 days of performance. Here we're in April 8th as of today. But to your point, we're looking at something like a 10-point swing. But Nathan, to your point, the idea is we are holding an allocation of international that mirrors the world market capitalization, namely around 35% of our clients' portfolios approximately are in international, 35%, I should say, of the equity portion. So maybe break that down so clients can know high level what the allocation is to international. And then, Brad, I don't want to steal your thunder on just sort of like maybe showing some historical slides of how international has fared compared to domestic historically.
Yeah. So we, just to reiterate, we hold the market cap because we don't have convictions about which country is going to do better long term than the other. Now, when we say we're happy to be right for a quarter and things like that, it's not as if we're not capturing the U.S. based return. We're just not overweighting it. And so compared to advisors or clients who do overweight their portfolios to the U.S., it hasn't performed as well. But again, it's a long-term diversification point that we don't have an expectation of the U.S. market just clipping along at 12% indefinitely, and we'll go into that a little bit.
Perfect. And so, Nathan, if you have a 70% stock, 30% bond portfolio, what we are saying is the 70, so of $1 million, let's say $300,000 is in bonds, $700,000 is in stocks. Of that stock portion, it's split 65-35. So that's $700,000. 35% of it, now we're on the spot doing math, but 35% of that 700,000 is in international. 65% of that $700,000 is in domestic. Is that?
Yes. Now we're not going to we'll let it drift about 5% either direction, because we don't want to be making trades every day. So it's not like when that the US does well and 65 becomes 66, it's not like we go in there and start messing with things. We'll let it drift a bit on. We have kind of a tolerance band, it's called, on either direction. So yeah, somewhere between 60 and 65% US is where our portfolios will be.
And maybe as far as an emotional point, would it be fair to say that a lot of the headlines aren't discussing the performance of international public stock? It's really focusing, Wall Street Journal, New York Times, so much as they do report on performance, it's really talking more about the Dow, talking about the S&P 500. These are domestic benchmarks that are showing the United States performance. Is that fair to say? So when our clients see the headlines, recognize it's not your whole portfolio. You are diversified out of that in bonds and international to the tune of probably over half of your portfolio for most people, even in a 70-30 portfolio.
Yep. Yeah, and that's the case because, a lot of market performance right now it's not controlled by, but it is wrapped up in the same, world events and narrative that a lot of our political happenings are wrapped up in. And so we have a lot going on right now, to say the least. And I would just encourage people, if you're concerned with some of the political decisions, which I think are valid, you don't want to necessarily map that onto your portfolio, because the portfolio is doing something different than, again, just a US-based scenario. And even the market itself is not controlled by a few people with a lot of power. It is controlled by millions of investors deciding prices every day based on lots of other information than just politics. So
yeah. Cool. Okay. Yeah. So Brad, I cut you off. Did you have some more international historical slides that you were going to show?
No, I've got some good slides. I was going to run through the valuations, which we've run through in quite a bit of meetings. But if you go to slide 10, if you wouldn't mind, Nate, is that you driving?
Mm-hmm.
Cool. Yeah. So this is just the valuations. I'm sure you've talked to your advisors in certain meetings and just looked at this, but really what you're looking at is the valuation of the overall market. And you can see the US equities at the top is pretty stretched. So we haven't seen these types of valuations since the dot-com boom. And so heavily stretched, the Magnificent Seven makes up about 30% of the S&P. And so that's why you're seeing a lot of the volatility. These stocks like NVIDIA, they've got a 65, price to book ratio, which is crazy. Anything that goes wrong in the markets, the U.S. market's going to feel that because they make up a third of the market cap. So that's what you're looking at right there. You're looking at the global equities as well, being fairly valued. You're also seeing U.S. value and small cap fairly undervalued. And so we do have tilts in our portfolio, not large ones, but maybe Nate could speak a little bit more to that. We do tilt a little bit more towards U.S. value and U.S. small cap, which we think the runway for is very good.
Yeah. So value, by the way, is just another word for cheap. So we overweight, if we're talking about overweighting, we do overweight towards cheap stocks and overweight towards small stocks. Two reasons for that. It's easier to make money when you buy something kind of on sale, so to speak. If I can translate this to real estate, buying a fixer-upper and putting money into it and then selling it, that's called value investing in the real estate world, and it's not too different on the stock side. You're going to make more money that way than just going in and buying an expensive property or an expensive stock and hoping the market itself appreciates. That makes sense. You're creating value rather than just hoping and with stocks, it's not just the market appreciating. If it's a growth stock, what's happening is we're betting on the future of that stock. It's a company that is, NVIDIA is a great example. They're doing something that's quite literally probably going to change the world. Now we are betting on the future of what that looks like quite a bit more than, if you invest in Kmart, for instance, on the cheap side. Value stocks are not sexy. They're companies that are kind of on sale, but it is easier to make money over time buying cheap than buying expensive. And then small stocks, it's just very quickly, it's easier to grow a small company than a large company. 25 Financial will have probably a higher percent growth this year than Wells Fargo. And that's not because we take on more money than Wells Fargo. It's because we're a smaller company and they're a large company. It's easier to grow a small company. So those two things, we do over tilt or we overweight a bit. It's modest. It's not a lot. But we overweight those in our portfolio, and they look really good right now, to Brad's point.
So to piece some of this together, the two takeaways that I'm hearing for our clients' perspective to sort of summarize. Number one, U.S. equities are very overvalued. Brad, this is your point, right? So it's like one way of sort of describing that, and maybe you can edit or use your own anecdote. But what I always say is, hey, this shirt here is let's say $100. That's what it should, sort of should cost based on its book value, based on what the value of the shirt would be sort of on paper. And all these companies have book values, meaning assets and liabilities. You should be able to open, and see what the company should be worth. Now, the problem is this shirt, if it were NVIDIA, is selling at like $10,000, $5,000. They're overpriced. Maybe you're betting on the future of NVIDIA, et cetera. For whatever reason, they're overpriced. The millions of people that come together to set the price are paying more than what the book value is. That is what we are describing as the sort of the overvalued. And to maybe speak to that, as a sort of a first point, meaning if they're overvalued, at some point there might be a correction, or will be a correction at some point coming to bring it back to what the book value might be. Nobody knows really how or when that's going to happen. But maybe the second point here is that the headlines, again, sort of the emotional point here, is that we are not only diversified with international, we're not only diversified in bonds, such that the headlines that you're reading really aren't affecting or probably even talking about over 50% of your portfolio. But even the part of the portfolio they are talking about, the other, let's say if in domestic, we're even diversified in such a way that the stuff you're reading about probably are not the companies that much of your domestic money is actually getting put into. Another point of diversification. So maybe edit both of those 2 points that I just made, the overvaluation point and then the further diversification point.
Yeah, it's so if you pay attention, we're almost speaking out of both sides of our mouth, because we're saying on the one hand, prices are fair, or lots of people get together and set prices and they're accurate. On the other hand, we're using language like overvalued. And that's actually consistent, because we're when we say stretched or overvalued, we're thinking in terms of relative to its history. And so what this chart is saying is it's relative to history, and I'll go to the next chart because it'll make the point over time. Relative to its history, U.S. stocks have gotten more expensive. So this chart is not a chart of performance. It's a chart of what stocks cost versus what they're earning. It's like a price to earnings chart. The dark blue line is the US, and then yellow is international, developed, emerging markets is the teal. So you can just see since 2009, basically since the financial crisis, US stocks have continued to get more expensive. Now, that's not necessarily a bad thing if the outlook on US stocks is favorable, but it's also not bad to notice, hey, historically speaking, this is getting expensive. So you kind of want to have both things in mind, that on the one hand, prices are fair. On the other hand, you want to notice when things are historically expensive. And that's kind of the valuation point we're making here. And so
in the second, that's really helpful. The second, so the first point, I love this slide. I like to show this as well. I don't like buying things that are not on sale. It just drives me nuts. And to your point, it's kind of like they are efficient. The markets are efficient. This is what the stock is worth because we have so many transactions happening every hour. On the other hand, darn it, this company has a book value of X, and we're buying 60X. 40X, 10X, what that book value is. We can see what assets you have. We can see what liabilities you have. In any private company, that would matter on a buyout. when we're in a public company, that has to have some bearing on it. But to your earlier point, it is consistent even with the actual price. But with that said, when one of the Magnificent Seven come down in price, think of it as potentially going on sale versus and people talk about buying the dip and that kind of stuff, all of which we don't do. And that's the whole point here, is that we are already batting down the hatches. We've already been diversified. And that's the second question, Nathan. Talk about that diversification point. So again, breaking this down for $1 million per $1 million portfolio, a lot of our clients have 70% stock, 30% bonds, or maybe 80% stock, 20% bond portfolios. But let's use a 70-30, sort of that moderate portfolio as an example. And again, speaking to the emotional side of this, as you're listening to the news, you're reading about the tariffs, you're seeing all the ups and downs, and maybe this company is going to negotiate, maybe this one won't. And then what part of the portfolio at the end of the day are we actually referring to when we talk about the S&P 500? Let's just go brass tacks, or the Dow. I mean, we're talking about something like, I don't know, I'm just 5% of the average portfolio at 25 financial. I mean, maybe break this down where it's like when we hear these headlines and the things that we're looking at, how big of a percentage of our portfolios are we actually referring to?
Yeah, thanks for putting me on the spot there. I don't have that memorized, but my gut would, that's easy to access. I could look it up, but I don't want to fiddle around. I would say it's probably closer to, what do you think, Brad, like 20% for a 70-30 portfolio will be large cap?
S&P and the large caps. Yeah, it's a small percentage, just like the S&P is. But like you said, that's the headline news that you see every day.
Yep. So to your point, Randy, it's it's not a sliver. It affects your portfolio, but it is not your whole portfolio. What you see on the news is not the same as your portfolio.
Mm-hmm.
And it shouldn't be.
And we'll just put a quick plug in here as well that, the 70-30 portfolio represents typically around 70 or maybe 80% of our clients' overall investable net worth with 25 Financial, because anywhere between 10 and 30% on average, that ballpark clients will have even outside of the stock and bond market, which is beyond the scope of today's conversation, but it is to say that provides even more diversification and assets that are not correlated with the headline news. And so that would actually put us probably closer to that 5% of your overall investable net worth if you're an average 25 financial advisor with something like 10 to 30% in alternative investments. It's not enough. None of this is enough to lose sleep on. And that's probably another discussion as well, of sort of the role of money in our lives. But it is something you said earlier. What is the relationship that you want to have with money? But to go through some of these slides, so far we've talked about international, we mentioned bonds, we talked about what is being overvalued right now, we looked at small versus growth stocks, and we're starting to use a scalpel approach in breaking down these portfolios, and it's not a one size fits all, which typically the headlines are speaking to. What other slides do we have that you think would be helpful to continue on that scalpel approach and educational approach?
Brad, you had a couple more you wanted to go through, right?
Yeah, why don't you just start clicking through? I can't remember what I threw in there.
So we went through valuation. This
the
is
expected returns.
Returns going forward.
This is a good one, Brad. Yeah, this is great.
Yeah, so if you look at this, it's really interesting, but I just saw something from Goldman Sachs that came out, I don't know, a month ago, and they ascribed a percentage value, expectation of the S&P, what they're going to do over the next 10 years. And I think they gave it a 75% chance that they'll do under 3% a year. And so if you look up at that US equity chart, you can see around 2 to 4% is what expected. You can see the large cap is around the same amount. And then if you look at that US growth, it is actually negative. So I don't know when that turned negative, a small part of that expectation, but that was interesting all by itself. So expected returns over the next 10 years, obviously, if you look at historical data, you're doing more like 9% a year. Same with international. And so, the U.S. has gotten out ahead of itself over the last 14 years, which we've got more charts to show on that, just how overvalued it is. But just wanted to make the point that U.S. is overvalued, that we already mentioned, and bonds are kind of in the middle right now. And they've got that yield backstop. That's what, Vanguard refers to as just having some type of income. So when we saw the big fall in 2022 with bonds and stocks, Randy, I think you mentioned before, but both of those going down the same year and ending the year down, that has only happened 3 times in our history. And so a couple of different reasons. Rates were at 0, so we weren't getting yield. And so basically we were relying on all the price appreciation to get us home. And so if there's neither of those, that's why we had the big price drop in bonds, down about 15% in 2022. And so that's why I say we have the nice yield backstop right now. Maybe you're getting a coupon of 4 to 5%. If you hold it out to maturity, maybe you're there. So anyway, that's a good slide. That's just the Vanguard expected returns over the next 10 years.
Yeah.
So it's sort of shocking to see that the U.S. I mean, for clients that are used to that 13% return in the S&P or large company, to see a 2 to 4% projection from Vanguard is a bit shocking.
Now, a couple caveats here. Projected returns they haven't happened yet, right? So it's not actual returns yet. We could be wrong. Vanguard could be wrong. But this is what you would expect given where valuations are at today. One other thing, just to kind of bring it home for some of our investors, is if you look at the expected returns of bonds, the entire bond market below this line, it's about the same or higher as just the U.S. equities market as a whole. And so this is the first time in our careers where bonds are relevant enough that they're not just sort of there taking up space. You will likely see a good amount of value out of the bond side of your portfolio in the next decade and going forward.
Excellent.
Good point.
That next slide about sort of the historical international versus there we go.
So this is just bare and bold.
Yeah,
I want to go over this one. Go back to the 100K. Sorry.
Oh, the 100K.
Yeah. There we go. So this is like one of my favorite slides because we get this question, not often. We've kind of trained everybody to buy and hold and stay diversified, all that. But I do get a couple of people, should I move the cash? You might even have a family doing it. We've all heard the horror stories of getting out, not knowing when to get back in. But basically what this slide is saying is if you put 100,000 in back in the mid 90s in the S&P 500, you stayed invested and didn't get in or out, you would have 2.2 million today or in December 2024. Now, if you skip down to the very bottom and just take out the 10 best and worst days, so maybe there's some days in there that did a positive 10% or a negative 10%. If you were really that good at picking stocks and getting in and out of the market at the right time, you would have stood to gain another 10% on your money, which for me, that would be a lot of headache. I don't know about you guys over the last 30 years of investing, trying to time the markets, do all the diligence, trying to figure out valuations, getting in and out, all for a measly 10%. And also on the flip side of that, if you go up to the missed 5 best days in the market over a 30-year period, maybe you got out at the right time, but you didn't know when to get back in. If you just missed the 5 best days over a 30-year period, your portfolio would be 37% less than had you just invested throughout the time period. So you can go down there, the 54%. This is a crazy slide, and it really just hits home why you should stay diversified and why you should stay invested in the markets.
I don't have this in front of me, but one thing to point out here is that many of the best days in the market happen after market, they're recovery days. And so, for clients that are saying, should we get out before it keeps doing this? To go back to the first point, markets work, so you don't want to try to guess if it's going to keep doing that or not. We don't know. The big risk you're taking by doing that would be missing out on recovery, which tends to be, a lot of this data comes from the swing back up, which if you miss that, you're prolonging the recovery of your portfolio by potentially years.
Yeah, I think we use the example, Brad, in our meetings of just, you go to the hockey game, you're sitting there, maybe you like hockey. I'm not a huge hockey fan, but most people aren't huge soccer fans in the United States comparatively. And it's like the one time you get up to go to the bathroom, get something to eat, they score the goal. And it's sort of like, man, I spent 3 hours of my life here and I missed the one goal. That it seems like that. Would you say that this sort of fits? And I love, Nathan, your addendum that it typically is right after we have these downturns is when we have these spikes, and it happened. I have to say there was an article I wrote in spring of 2020. It's called How to Outrun, it's something to outrun investing or that kind of thing. It's on our
Yeah.
blog at 25 Financial. The
Well covered
day
with it.
I wrote
Yeah.
it was and if you look at the actual date, I got lucky, but that was the bottom. And the punchline of the article was, when everyone else is selling, you want to be buying, buy the dip kind of thing. And of
Mm-hmm.
course, I couldn't have known the future. It was just a complete, just academic sort of stay the course article. But if you have a client, or if you are a client that's right now considering, I have to do something in order to assuage these feelings of fear and panic,
Yep.
recognize that by doing something in this area, namely selling out of a certain sector or selling a certain stock, if you miss the one day, if you miss the 5 days, the 10 days, or even the 30 days, it is almost unrecoverable. You cannot compete with people that just stayed the course the entire time.
Yeah. And
And
this is
also to
not a
hit that
recent.
point, sorry, I always use this
No, no.
example, but if you've got $1 million portfolio, say it drops 25%, you sell and get out. If your portfolio is now down to 750 from $1 million, you actually have to do a 33% return, not a
Yes.
25% return, because your portfolio is now smaller. So some people forget that, but that's just another point on that.
It's a good point.
This
Well,
after crashes, that's actually sorry, real quick. That recovery phenomena after crashes is a very long-term phenomenon. We have data back to like the 1600s for that.
yeah. And I've seen the slides as well. That's been super helpful. Let's wrap up this session with any final thoughts, slides. This has been super helpful. And as you're looking and gathering those last slides and thoughts, sort of the takeaway here is really we've looked a lot at the different sectors, and we've sort of sliced and diced the portfolio down and said, look, we're not all in what you're reading in the headlines. That is a very small portion, especially if you use alternative investments for 10 to 30% of your portfolio. That's just not really describing your portfolio in any large percentage. Another thing that we've talked about is sort of where the U.S. is positioned on the valuation scale, and sort of what the projections with Vanguard. And of course, they are just projections, but they do have a lot of research that goes into those. And then we also are sort of very emphatically saying we don't want to move into a position of panic right now, or at any time. And so just maybe I'm hearing you say, hey, everyone, take a deep breath if you need one. Hopefully these slides have helped. Hopefully this conversation has helped to assuage some of that panic, some of that fear. And then I've also heard you sort of make this distinction: if you have a political fear, or if you're politically really excited about who's in office, don't let that filter into your portfolio decisions.
Don't map that onto your, right. Yeah, because the world is bigger than if you've heard the phrase, the map is not the territory. We all have a mental map of the world, and it's incomplete. Our model of the world is not the same as reality. And so you don't want to map your political vision onto your portfolio, because there's a lot more going on in your portfolio than just what a few people are doing. And
Excellent.
that's true whatever side you lean.
Final
I think there's
thoughts.
one final slide. Yeah, U.S. International. I was just going to hit that home, just the bull market that we're on. So I think it's the very last one. Yeah, there we go. So another one of my favorites. I think, Randy, some of our clients have seen this, but this is just the bull market run that the U.S. and international have done. So if you go back to the early 70s, you can see in the purple, that's international. You can see 80% right there over 2.5 years. What that means is the international markets outperformed domestic by 80% over that time period. Moving all the way up to the big charts. So 299% over 5.6 years where international outperformed. And then you've got the domestic at 6.2 years outperforming by about 222%. Most of these time periods, if you've noticed, are around 2.5 to maybe 6 years. If you scroll ahead over to '08, you're looking at about a 14-year bull run. And then if you tack on another 2 years, you're looking at about 16 years. So you can really see how this ties into what we were showing earlier with the current US valuations and where we're at and where we think they're headed, and that international might have a runway here. So wanted to mention that, and then I know we want to wrap up with a few tactical just points that we might make if you want to do some of your portfolio. But yeah, any thoughts on that from either of you, and then we can just go into thoughts and maybe action points.
Yeah.
No,
Final thoughts. We're sort of saying tactically, we don't want to pick stocks. We don't want to try to time the market. But what can we do? What are some moves that we might consider right now?
I've got a couple. I mean, really, if you're looking at maybe an IRA or something that's dropped significantly, maybe it's down to 10, 15% on certain positions, that you wouldn't mind moving over to your Roth, that we're not going to trade in. So what you don't want to do, and what the portfolio team will work on, and you don't have to worry about it. What you don't want to do is look at something in your IRA. Maybe it's a bond position. We don't hold bond positions in your Roth IRA. So we wouldn't want to convert that, because we would just end up selling it. And so basically, to simplify that, if you put 100 grand in and it's down 20 to 80,000, it might be a good time to convert some of that position. So that might be an option. I don't know who's heard about direct indexing. I know we have a YouTube channel or YouTube video on all of that, but that might be a good option. We're seeing a lot of losses being racked up currently with the US markets and where they're at and where they're headed. So we're really taking advantage of what's going on inside the markets and really starting to rack up some of those losses. So we'll be able to offset with gains moving forward. So
Brad, do you think in a nutshell you could just give us a quick pitch on direct indexing, why losses are good in that environment?
Well, if you look back, over the last 100 years, traditionally the stock market's up, and I think we even had a recession thing where you can see, the average recession lasts 300 days, the average bull market lasts like 1,100 days. If you go in that mindset, you're always going to have gains in your portfolio, but nothing to offset it. You need losses to offset those gains, otherwise you're paying those high capital gains taxes. And so what direct indexing is basically, the S&P 500, we always use that example. What Vanguard will do, they'll go in there and buy like 300 companies out of the S&P 500 and hold them individually. So that's not something you do in traditional markets. Traditionally, you have to buy the entire index. They'll actually go in there, they've, completed an algorithm. They actually bought this company. It's the only company they've ever purchased, which has an algorithm. They go in there and look at tax alpha on a daily basis. And if they can get, 1 to 2% of tax alpha on that day, they'll go ahead and purchase and sell something else. And so if Coke goes down, maybe they sell Coke, they'll look to buy Pepsi, and there won't be much tracking error within the portfolio. So basically you'll line up to an index, and for our portfolios, you cannot hold international because there's trading fees inside of the indexing portal. You also cannot hold bonds. So really that just leaves your domestic stocks. And so basically what we do is line that up against our model, and they will trade, sometimes on a daily basis, but basically they're looking to rack up losses while also tracking with the index. And so you're going to see the bottom line. It's basically going to say tax alpha, in your tax rates, state rates, federal rates, this is what you did. And this is what you would have done on your own. So really that tax alpha is what you're looking for from Vanguard.
So maybe one way of describing it is like it's a Vanguard index fund that captures the losses along the way. And we have a whole direct indexing, really great discussion, I believe, with one of you or me, I can't remember, with our Vanguard team that goes through this. But Brad, to your point, the idea is, hey, look, if you have IRA money, stocks have taken a nosedive, you convert it in kind. So we're not selling the stocks, you're converting it in kind. And it's basically just moving the stock that just lost a bunch of money from your rollover IRA over to a Roth IRA. You pay the taxes on the lower value, and then you wait until it comes back up. That's an IRA strategy that we can do right now, or consider doing right now. And then the money stays in a Roth IRA and grows completely tax-free forever. The other strategy is for cash. And the idea of cash going into a direct indexing fund, it's like remaining diversified. You track with the index. It's a Vanguard type index strategy that you can sell, or that you can recognize losses along the way as they sell. And we can get into the weeds on that in the direct indexing. But these are two strategies that you can do right now. If you feel like you have to do something, there are things you can do. And these are things that you can do right now that would benefit you on the cost side, that third sort of tier that we didn't really get to in saving on the taxes as well. And the direct indexing has a low internal expense ratio as well, something that we can get to another time. But for right now, any final thoughts as we wrap up? It's been super helpful. You guys have, I think, unpacked for clients that maybe have never heard this, kind of how the anatomy and the structure of the portfolio actually compares with the headlines they're hearing and they're seeing. And of course, for the people that have already heard this, I think it helps to bring the temperature down a bit to say, the stuff they're talking about is just really only a sliver of our overall investable net worth, and maybe not worth losing a wink of sleep over.
Right. Yep. The only thing I'd add to that is if you do have a lot of money that you're putting to work right away, alternatives. This is why we do alternatives. That's a good diversifier in itself. And then if you're doing money into the market, with how choppy it is right now, it's probably best to do something called dollar cost averaging, where you're not dumping it all in one day. You're doing it a little bit at a time over the course of a few months. So, and that kind of helps smooth out some of the volatility. But yeah, for the most part, it's a long-winded way of saying stay the course.
Stay the course. Nathan, Brad, thank you guys so much for your time and expertise and all you do for the clients' portfolios, and bringing our fears down and sort of injecting some education to the mix here. And so really appreciate your time. Thanks so much.
Great. Thanks, Randy.
Thank you.
Take care. Bye.